Hello everyone, welcome back to Mindful Investing and to the 14th stock in my stock prediction series where we mix data, fundamentals and technicals to forecast both 1 year and 5 year price targets. Today we are covering CELH Holdings, currently trading around $35 per share with a projected 1 year price target of $49 and a 5 year price target of $186. I personally hold 10 shares at an average price of $22.40 in my swing trading account. And yes, I think it's a screaming buy right now. But let me walk you through why. CELH Holdings isn't your average energy drink company. They are a functional beverage powerhouse creating healthier, sugar-free alternatives for the fitness-conscious generation. Their main products are CELH, their flagship energy drink line, CELH Hydration, and they recently acquired Alani Nu, a massive move that gives them access to a broader health and wellness demographic. What makes CELH special? They are not selling just drinks, they are creating a lifestyle brand that taps into wellness, fitness, and cleaner energy. Their revenue streams come primarily from direct-to-consumer and retail sales of CELH drinks, licensing and distribution partnerships including PepsiCo, expanding international markets and brand extensions. Let's break down CELH's Q1 2025 earnings in simple terms. The company brought in $329 million in revenue, which is about 7% less than the same quarter last year. At a first glance, that sounds like a bad news, but let's dig deeper. Sales in North America, which is their biggest market, dropped 10%, mostly because they changed how and when they offer promotions and discounts. And the international sales, on the other hand, soared by 41%, thanks to their strong growth in places like the UK, France, and Australia. Despite making less overall revenue, they were more efficient. Their profit margin, which means how much money they keep after covering product cost, actually improved, rising to 52.3%, which is a good sign of financial strength. However, profits did take a hit. The net income, which is the bottom line profit, fell 43% compared to last year. Their adjusted earnings per share dropped from 27 cents to 18 cents, meaning they made less money for each share of stock. And adjusted EBITDA, which is a measure of overall profitability, fell from $88 million to $69.7 million. In short, while this quarter looked weaker on the surface, the dip was mainly due to timing issues with promotions, not a drop in demand. In fact, the business is still growing internationally and becoming more efficient. That's a healthy sign for long-term investors. So yes, overall, revenue was down, but this wasn't a demand issue. It was a timing related due to incentives and promotional shifts. The company is still growing its market share, especially internationally and through the Alani Nu acquisition. CEO John Findlay summed it up very best. We saw business fundamentals strengthen through the quarter and we are encouraged by positive momentum heading into Q2. Now let's get into my favorite part, which is the price forecasting. Here's the data I used. The current PE ratio of CELH Holdings is 45 cents. Expected annual EPS growth rate is 39.5%. Current PE ratio is 78.61. And the current stock price is 35.5. Using these values, the 1 year price target is $49, which is a 39% upside from today's level, assuming CELH grows their EPS by 39.5% and maintains a similar PE ratio. And the 5 year price target is a $186. If they compound earnings at 39.5% annually and the market values them at a similar multiple, are looking at 425% upside. That's a 5-bagger potential. Now let's talk technicals. CELH is still trading below its 200-day EMA. That's actually bullish if you believe in the long term. It gives you a window to build a position before institutions jump back in. And coming to the key support levels, $22 seems to be a strong historical support, and then we have $13, which is a deeper value zone, but it's very unlikely unless the market crashes. So for me, buying under 200-day EMA is a smart move, especially if you're long-term focused. I've already started my 10 shares at $22.40, which means I'm up close to 60% on this. And I'm watching closely to add on more dips. And of course, there are some risks here. There are a few things to keep an eye on. The short-term earnings volatility, especially as they absorb Alani Nu acquisition, and their promotional spending and margin pressures. Also execution risks in global market. But the long-term story is intact. raising their market share, international expansion, and clean energy drinks in a booming category. In my opinion, Celsius is a high growth stock trading at a reasonable premium for the category it dominates. International growth is accelerating. It has a strong brand in fitness and wellness. The Alani new acquisition is a game changer for them, and it's trading below its 200-day EMA, which is a rare setup. And finally, it has a huge potential of 425% upside in 5 years. So is Celsius a buy? For me, it's a absolutely yes. It's already in my swing trading account, and if it dips again, I'll gladly add more. Now, I want to hear from you. Are you buying Celsius? Do you think 425% in 5 years is realistic or too optimistic? Drop your thoughts in the comments below. And if you enjoy this kind of breakdown, don't forget to like and subscribe to the channel for the next stock prediction in this series. Until next time, stay invested and stay mindful.